Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to follow up on a previous episode we did, episode number 5, where we talked about investing and a handful of key things to focus on in order to get you 80% of the way there when it comes to investment success. Well, today we're going to round out the discussion by talking about the remaining 20%. And in our prior discussion about investing, we talked about the Pareto principle, or the 80-20 rule, and how it makes sense to focus your efforts on what's going to most move the needle. And for some people with investing, that initial 80% might be good enough since they may not have the time or interest to go deeper. So if you at least follow those basic foundational principles, you'll stack the odds in your favor of having a successful long-term investment outcome. However, we know there's another group of people who are interested in going deeper. And in that regard, there are a number of additional things you can do with investing to achieve an even better after-tax investment return. So that's what we'll focus on today. And thinking about this last 20% is kind of like tidying up your house when you have little kids. You could do the basic things like having the kids clean up their toys in the main living areas, picking up their dirty clothes and putting them in the hamper, and putting their dishes in the sink. And that'll at least make the house look much better, and it might even be enough. Or you could go the extra mile of making sure their toys are sorted and organized, their rooms are cleaned, the dishes are done, the floors are vacuumed, etc. There's additional work and time involved in going that route, but the end result is going to be even better in terms of the house looking and feeling even more clean and organized than if you just did the basic.
Yeah, and at least in my household, I'd also have an incredibly happy wife.
Yeah, that'd be an added bonus across the board.
Yeah, but I think that analogy has to hit home even more for you with 3 boys.
Oh yeah, Jen and I are always amazed by how quickly they can destroy a room. It's like a tornado of Paw Patrol, Cars movie, and Octonauts came through.
Can't wait for that, but luckily Grant's a little bit easier now.
Yeah, for sure. So with investing in the remaining 20%, there are 4 different areas we're going to talk about: asset allocation, rebalancing, asset placement, and tax loss harvesting. And Andrew, why don't you kick it off by talking about asset placement?
Yeah, and before we go into this section, we only start to focus on this last 20% after we know that we have the other 80% taken care of. So when you're thinking about that last 20%, asset allocation is the best place to start of methodically working through the bigger items first. In simple terms, asset allocation is the mix of investments you have spread throughout your various accounts. And there are 2 main types of investments that make up your asset allocation: stocks and bonds, which we refer to as asset classes. But within each of those asset classes, there are many subgroups: U.S. stocks and bonds, international stocks and bonds, certain types of stocks like real estate stocks, technology stocks, stocks of big companies, stocks of small companies. So there's an exhaustive list of what we call sub-asset classes. In our first episode on investing, we talked about the idea of diversification and how rather than owning a handful of stocks and bonds, or stocks and bonds in just one country, you should own thousands of stocks and bonds all across the globe. This is the idea of not putting all of your eggs in one basket. And by diversifying your investments over several asset classes, you're able to reduce risk, which we describe as having a smoother ride over time with less dramatic fluctuation on a daily, monthly, or yearly basis. On top of having a smoother ride over time, you'll also be able to improve your long-term investment returns. So diversification is really the only free lunch you'll have when it comes to investing. And to take it a step further, I'll go a little deeper on why diversification is important and how to think about deciding on the right asset allocation for you. And taking a step back and seeing the big picture, when you hear about the stock market, most people think of common proxies they see in the news, like the S&P 500 or the NASDAQ. But those only consist of U.S. stocks. And while that's a good starting point, since the U.S. does make up at least a larger percentage of the global stock market, many people don't know that the U.S. only makes up about 50% of the global stock market. And a common misconception is thinking you have a diversified portfolio because you own various investment funds in the U.S., which is why it's so common for people to have close to 100% of their investments all in U.S. stocks. And while that's better than just owning a couple of individual stocks, we wouldn't consider that diversified because you're missing exposure to the other 50% of the global stock market. So when it comes to looking at the stock portion of your asset allocation, you want to make sure that you invest outside of the U.S. as well. This includes not only developed international markets, countries like Japan, England, France, and Australia, but also emerging market countries like China, India, Brazil, Russia, and others. Now, having said that, over the past 10 plus years, the U.S. has had the best returns of the global stock market. So the natural reaction is, why would I need to invest in markets outside of the U.S.? And this is where people fall victim to a recency bias, where people assume that what's happened over the past 10 years will continue for the next 10 years. However, most investors have much longer time horizons than just 10 years. And when you look over longer time periods of 20 and 30 plus years, you notice the performance for global markets has historically been cyclical. In other words, one country or region might have been the best performer for 5 or 10 years, but then things later shift and that area does worse than other areas that may have been underperforming in the past. And like we mentioned in our last podcast about investing, no one can predict the future or know when the cyclical shift or trend will change, and trying to do so will cause more harm than good. This is why a better solution is to be diversified across all of the global markets, so you'll capture the blended return of the global stock market, both the good and the bad, but the sum of the parts equals the whole. And that's why we want you to focus on what your after-tax return of your overall portfolio is, and not just any one investment. Sure, during those periods where the US stock market does the best, you'll wish you didn't own any international markets. But then during those periods where the international markets outperform, you'll be glad you did. And that's exactly what diversification is. Your investments perform differently during different time periods, which is why the ride is smoothed out for you over time.
Now, another thing we want to touch on when it comes to asset allocation is something called factors. And as discussed, one dimension of looking at stocks as an asset class is their geography. However, another dimension is looking at the size and type of company you invest in. And we can go pretty deep into the weeds when walking through this, so we'll try to keep it higher level and focus on the biggest parts, which are comparing small versus large companies and value versus growth companies. And one thing to add here is that we're using the terms stocks and companies interchangeably because when you invest in a stock, you're buying a partial percentage ownership of the underlying company. With that in mind, investing in small stocks, as it sounds, is investing in smaller companies, many of which you've probably never heard of. Whereas investing in large stocks consists of buying bigger companies that we've all heard of, like Amazon, Apple, Facebook. For many investors, there's a certain level of comfort that comes with knowing the name of the company you're investing in, which is why many investors own a disproportionate amount of their stock exposure in large US companies. And the logic makes sense, and thinking about it another way, if Amazon asked to borrow $100 from you and said they'd pay you back $102 in a week versus another company you've never heard of proposing the same question, you'd probably be more comfortable lending the money to Amazon. It's simply because smaller companies are less established, which means they're riskier compared to larger and more established companies. However, when it comes to investing, risk and return tend to be correlated. So because smaller companies are riskier, they offer a higher return as compensation for investing in them. By investing in smaller companies as well, both in the US and internationally, and not just the large companies you've heard of, you further increase your diversification and also the opportunity to achieve better long-term investment returns. The trade-off is that on a day-to-day or year-to-year basis, the prices of these stocks may jump around more in both directions, which not everyone is comfortable with. And shifting gears slightly, outside of looking at investing in small versus large companies, the other aspect to consider is looking at value versus growth companies. Value stocks are companies whose stocks are cheaper, at least based on the relative valuation of the company. So for each company out there, it has a certain valuation, or the price of the company as a multiple of its earnings. With value companies, when you buy the stock, you're paying a lower price relative to the company's earnings. And since your return on something often comes down to the price you pay, your subsequent returns from buying value companies are likely to be better. One way to think about a value stock is like buying a house and later selling it, where part of your profit depends on the price you initially paid when you bought it. Growth companies, on the other hand, are stocks that have a high price relative to their earnings, and may potentially not have any earnings at all. And people invest in growth companies with the hope that the company will grow faster and eventually have earnings high enough to justify the price at which they bought the stock. Again, we won't go into too much detail here, but a couple key takeaways to know are that there are different types of stocks, which are typically broken down into size, small versus large, and type of stock, value versus growth. And historically, over long periods of time, think several decades, smaller companies and value companies have outperformed the overall stock market. Now, similar to what we mentioned with US stocks versus international stocks, small versus large stocks and growth versus value stocks also tend to move in cycles. So while small cap and value stocks have historically had higher returns, they've lagged behind large and growth companies over the past 10 years. And the same logic we shared around investing in international stocks versus US stocks applies here, because over time you'd expect that trend to reverse. And in fact, we've already seen it happen quite dramatically over the past 6 months or so, where small and value stocks have been performing much better than large and growth stocks. But that being said, when talking about anything related to investments, we always have to mention that past performance is no guarantee of future performance, and there's no certainty that things in the future will be similar to the past. But the idea here is that when focusing on the other 20% of investing, these incremental tilts to your portfolio at least stack the odds in your favor of having a better investment return over time.
Now, up to this point, we've only talked about stocks, but another important part of your asset allocation is bonds. And bigger picture, bonds aren't going to be as sexy or what allows you to retire earlier than expected, but they serve an important role in your portfolio. And we describe bonds as your war chest or safety bucket, which is available for periods when the stock market is temporarily down, and this becomes increasingly more important as you approach retirement and have to start withdrawing from your investments. So in thinking about bonds and knowing this is meant to be that war chest for when the stock market is temporarily down, you want to focus on having this be that safe part of your portfolio. What that looks like in practice is similar to stocks, where you just need to have proper diversification across thousands of different bonds. And luckily, this can be done by using just 1 or 2 bond funds. But you also want to know that you have high quality or safer bonds, which the industry jargon for this is investment grade bonds. In simple terms, the way a bond works is you lend money to the company or government, and they promise to pay you back a predetermined amount of money in the future. And in return for you lending money to that company or government, they will pay you interest, similar to a savings account, on a monthly or quarterly basis. So when deciding how to invest in bonds, the 3 biggest components are, number 1, the interest they'll pay you, number 2, the maturity or time period before they pay you back the money, and number 3, the credit quality of the company or institution you lend money to. For example, lending money to the US government is viewed as having a higher credit quality relative to lending money to a company that you've never heard of. Now, within those 3 components, there are trade-offs you can decide on. If you wanted to get more interest along the way, then you may have to lend money to a company or institution with a lower credit rating. However, the flip side is that by doing this, there's also risk that the company or institution you lend that money to may not be around when it comes time to pay you back that initial money that you gave it. And following similar logic, in general, if you lend money to someone for 30 years versus 5 years, you should also be paid more in interest along the way, given how long you have to wait for them to return the money to you. So that's a quick, high-level overview of the main factors in bond investing. But going a step deeper, there are many different types of bonds you can invest in, like U.S. government, municipal, and corporate bonds. And when deciding what bond type is right for you, you'll want to factor in all 3 of those main components: the interest, the maturity of the bond, and credit quality. But going a step deeper is looking at how bonds are taxed differently. For municipal bonds, depending on the state you live in, you may be able to have tax-free interest for both the state and federal level, which is appealing for those in a high tax bracket like most physicians. Because of the tax benefits from municipal bonds, they often have a lower interest they pay you than a corporate bond would pay you. So if you own bonds in a tax-deferred account, like an IRA, traditional 401k, 403b, or 457b, you don't care about the tax-free nature of muni bonds and may instead prefer the higher amount of interest you can get from corporate bonds. The punchline here is that even though bonds are that less exciting portion of your investment allocation, you still can take advantage of some of these incremental advantages by understanding the tax treatment of various bonds and the factors that go into your overall return by looking at the credit quality and duration or maturity of your bond investments. And we know this whole discussion probably sounds like a lot, but know that proper asset allocation and portfolio construction is easier to take advantage of today because of ETFs and mutual funds. Within various ETFs and mutual funds, you can have a single investment that owns hundreds or even thousands of stocks and bonds, which allows you to get exposure to different areas of the world and types of sub-asset classes in a relatively easy way. So know that you don't have to go through and pick out a bunch of individual stocks or bonds, and you can have an extremely well-diversified, low-cost investment portfolio with proper asset allocation just by owning a handful of the right ETFs or mutual funds. And the reason we started with asset allocation as the first part is that studies have shown that proper portfolio construction, with the right diversification of investment funds and asset classes, can add roughly 0.5% per year to performance compared to a similar portfolio that doesn't take advantage of some of these incremental areas that we discussed.
Yeah, that 0.5% per year might not sound like a lot by itself, but the idea here is that each of these incremental areas all add up and can make a big difference over time, especially after factoring in the power of compounding.
Exactly. So assuming people have gone through and put together that portfolio with proper asset allocation, let's talk about the next incremental area to focus on.
Yeah, the next thing we want to talk about is rebalancing. And going back to what we just discussed, let's imagine that you went through and put together that right investment allocation for your portfolio. Well, you set it on day one, but the next day the market's going to move and your asset allocation will no longer be exactly how you initially set it. Over time, as different investments perform differently, your portfolio will drift further and further away from your initial target and look less and less like that allocation you originally intended. This is where rebalancing comes into play. Rebalancing is simply the process of bringing your portfolio back to your original target. And in practice, what it consists of is selling some of the investments that have outperformed and buying more of the investments that have underperformed in order to bring you back to your target investment allocation. In essence, it's a way to sell high and buy low, but in a disciplined and unemotional way without trying to make any guesses or predictions regarding the market. This is also contrary to what many people do, where they want to sell what's done worse and buy more of what's performed best. And while that seems like a logical approach, it often produces the opposite outcome, where you end up selling low and buying high. And when it comes to the actual process and logistics of rebalancing, there are different ways to approach it. One of them is a set calendar schedule, say once a quarter or once a year. You pick out a certain date and cadence and rebalance your portfolio on that schedule, regardless of what's happening with the stock market. While this approach is better than nothing, research has shown that there's a better way to rebalance. You can use something called tolerance bands for your portfolio, where you only rebalance when your investment allocation drifts outside of certain parameters. For example, if the stock bond mix moves by more than 5% from target. say from 70% stocks, 30% bonds, to 75% stocks, 25% bonds. And going even more granular, you can set additional tolerance bands within the broad groups of stocks and bonds by looking at the sub-asset classes. For instance, within stocks, the U.S. market may be doing better than the international markets, or smaller companies may be doing better than larger companies, so you can have a tolerance band at that level as well. And the reason having these tolerance bands is more effective than a once-per-year rebalancing approach is that it allows you to take advantage of something called momentum, which is the tendency in the financial markets for the prices of investments to drift over certain periods of time, often more than they should, in both directions. And said differently, you let your relative winners continue to ride on some positive momentum before selling them, while you let your relative losers, or the underperforming investments, drift a little lower before buying more of them. So having tolerance bands is step one, but the next step to focus on is the timing of when you check your investments for rebalancing opportunities. And here, the research shows that the optimal time period is looking every 2 weeks. This certainly doesn't mean that you trade every 2 weeks, because your tolerance bands might not show a need to trade, but it allows you to capture incremental rebalancing opportunities before the momentum shifts against you. Now, we talked about tolerance bands and frequency of rebalancing from an overall perspective, but we didn't discuss how cash flow, adding or withdrawing money from your investments, plays a role here. And to keep this relatively brief, we'll just focus on the accumulation phase where you're adding money to your various accounts and are deciding which investments you should add to. Similar to how we rebalance by selling what's done relatively the best and buying more of what's relatively underperformed, it's the same thought process of where you should invest new money. You want to invest in whatever investment is the most underweight to your target allocation, because that further helps you to take advantage of buying investments at a relatively lower price. Now, in working with our clients, we use trading software that helps us manage our portfolios and tolerance bands, but even without software, you can use an Excel spreadsheet or similar method to do the same thing. It's just a bit more tedious. And for some people, it may not be worth the extra effort of trying to implement tolerance bands, and for them, doing a set calendar rebalancing schedule may still be good enough, and certainly better than doing nothing. But for others, it may be worth trying to take advantage of the incremental returns you can get by being strategic with how you rebalance. And just to put a little more context around the benefit of rebalancing, studies have shown an estimated annual benefit of 0.4% per year from rebalancing. Again, something that may not mean a lot on a standalone basis, but that can add up over time, especially when combined with the first topic we discussed of proper asset allocation.
Yeah, you'll start to notice a trend here that these seemingly small incremental increases really add up when you put them all together. And when thinking about how to incrementally do a little better with how you invest, you want to focus on getting the best after-tax return, which is a good segue into talking about asset placement. And in basic terms, asset placement is simply which investments you own in which accounts. When it comes to investing, there's no shortage of different types of accounts available. 403b, 401k, 457b, 401a, IRA, Roth IRA, and a taxable account. So while you may not care to memorize all those various types of accounts, the key thing to understand is that different accounts have different treatment for tax purposes. For example, money in a traditional 403b or 401k or IRA grows tax-free from year to year, but when you eventually withdraw it in retirement, you have to pay tax on each dollar that you withdraw at ordinary income rates. For Roth accounts, on the other hand, the money also grows tax-free from year to year, but when you eventually withdraw it, you don't have to pay any taxes on it. And for taxable accounts, which are also known as a brokerage, individual, or joint accounts, you pay taxes on any taxable interest and dividends each year, but the only other time you pay taxes is when you sell an investment, at which point you pay taxes on the difference between what you bought the investment for and what you sold it for. And assuming the investment you sold was held for at least a year, the taxes you pay on the gains are taxed at capital gains rates, which are lower than the tax rate you pay on ordinary income from sources like your employment or money that you withdraw from your IRA or 401k or 403b in retirement. So as you can see, the different types of investment accounts have much different tax treatment, which means you can be strategic about which investments you own in which accounts to get a little better overall after-tax return. In practice, we break it down into a process of where we want to hold certain investments by starting with any Roth accounts. For Roth accounts, you want to own your highest growth investments in it, since the money will never be taxed again. Because of this, we always want to own stocks rather than bonds in this account. The next bucket is looking at tax-deferred or traditional accounts, like a pre-tax 403b or 401k. Since this is a tax-deferred account, you don't have to pay taxes on any gains from the investments you sell throughout the year, or the interest and dividends that your investments kick off throughout the year. And because of this bucket is great for investments that pay out a higher percentage of interest and dividends throughout the year. For example, bonds or certain stock investments that pay more in dividends, like a REIT fund, are best to be held in your tax-deferred accounts. And the last bucket is looking at any taxable accounts. You have to pay taxes on the interest and dividends from your investments each year, as well as the tax on any investments that you sell to gain. Because of this, you want to avoid owning investments that pay out a higher amount of taxable interest or dividends in your taxable account if possible. So if you do own bonds in your taxable account, depending on what tax bracket you're in, you may want to consider owning bonds with tax-free interest, like municipal bonds. And the last part to consider is a little bit more in the weeds, but it follows the same logic of trying to minimize the amount of taxable dividends and interest you have paid throughout the years. So stepping back when thinking about asset placement, you want to focus on the three main buckets. Number one, your tax-free bucket, or Roth bucket. Number two, your tax-deferred bucket, like traditional retirement accounts. And number three, your taxable account bucket. And trying to piece together the right asset placement for you is kind of like a puzzle, where you have an overall investment allocation, but you're trying to decide which pieces to own and which accounts to make your overall investments as tax efficient as possible. And when it comes to asset placement, it's tough to quantify the potential benefit in a general sense because the benefit will vary from person to person depending on their exact mix of accounts, investment allocations, and types of investments. But nobody enjoys paying taxes, and by being smart with your asset placement, it allows you to maximize your overall after-tax return just a little bit more. All right, it's one of our clients joked that it'll help you do your civic duty of minimizing the amount of taxes you pay.
That's definitely one of my all-time favorites.
Yeah, I know, me too.
And sticking to the topic of taxes, the last area we'll go through is tax loss harvesting. When talking about asset placement, we talked about the three main buckets of investment accounts. And tax loss harvesting is only relevant for the taxable account bucket. And as we just discussed, taxable accounts don't offer the same tax benefits as the tax-free or tax-deferred accounts, but they do offer the potential to deduct investment losses for tax purposes, which is where tax loss harvesting comes into play. The way tax loss harvesting works is that if you have an investment that's now worth less than what you paid for it, what you can do is sell that investment to lock in the loss for tax purposes, and then immediately buy a different investment, which must be considered substantially different, in its place. This allows you to recognize the loss for tax purposes while still remaining invested and not missing out on the upside when the market recovers, like you would if you were to sell a position at a loss and then keep that money in cash. The benefit of tax loss harvesting is that you can use the losses to offset future investment gains, or if you have a net loss for the year, you can deduct some of the losses to offset your taxable income. But either way, you can reduce your current or future tax liability. When it comes to deducting losses for tax purposes, you're allowed to deduct up to $3,000 per year from your taxable income. So to quantify your savings, you can multiply $3,000, or however much you're able to deduct, by your marginal tax rate. For example, for a Michigan physician in the 32% tax bracket, you would save not only the 32% federal taxes, but also the 4.25% Michigan state taxes. So the $3,000 of losses you recognize would save you close to $1,100 in taxes. And the nice thing is, while you're limited to recognizing $3,000 of losses per year, you can carry forward unused losses into future years until they're all used up. And when thinking about the best opportunity to do tax loss harvesting, it typically occurs during temporary pullbacks or corrections in the stock market. For example, during February and March of 2020, when the stock market fell by 35% during the course of only a month, we were able to take advantage of tax loss harvesting for clients. And knowing when the best opportunities arise, it makes that earlier point so important about once you sell an investment to harvest losses, to make sure you buy another substantially different investment in its place. And the reason this is so important is that pullbacks and bear markets in the stock market are always temporary corrections within a longer-term uptrend. So if you sell investments when the market is down to harvest losses, you want to make sure you remain invested to capture the subsequent rebound. Spring of 2020 was a perfect example of this, as the market fell by 35% over a short period of time, but then rose by more than 65% between then and the end of the year. And bigger picture, just to provide some quantification, while the value of tax loss harvesting will vary depending on the amount of money someone has in their taxable account and their tax bracket, on average for people in a high marginal tax bracket, it tends to add around 0.1% to annual investment performance. And one important caveat to note here is that there are some nuanced rules when it comes to tax loss harvesting. For example, you can't buy back the investment you sold for at least 31 days, or it'll be considered a violation of the wash sale rule, which means you can't deduct the loss for tax purposes. There are also rules around buying back that similar investment in a different account, for instance, in your IRA or Roth IRA, because that would also violate the wash sale rule. So before implementing any tax loss harvesting on your own, you'll either want to consult with a tax professional or make sure you fully understand all the rules. But with that quick compliance bit out of the way, and not to sound like a broken record, while that 0.1% per year benefit from tax loss harvesting probably doesn't sound like a lot, between asset allocation, rebalancing, and tax loss harvesting, that's already around 1% potential additional annual benefit to your investments, not to mention the extremely valuable but difficult to quantify benefits of proper asset placement. Well, that covers it for today's discussion, and hopefully it was helpful for everyone. As you might have picked up on, this is stuff where Andrew and I love to get into the weeds and nerd out on it, so we tried our best to explain it in basic terms to help everyone understand. And just looking at investments from the big picture, the way we view them is as the tool to execute your financial plan and accomplish your goals. So it's always important to first understand what you're investing for. We always encourage people to invest with a specific purpose, plan, and strategy in mind, rather than simply investing for the sake of it. But before focusing on the benefits of this last 20% of investing, you want to first make sure you have the initial 80% of investing covered, which we discussed in episode number 5, since those items are both the easiest to implement and will also make the biggest difference. But for those of you who are able to move beyond that to this next level, as you can see by refining things and pursuing the remaining 20%, you can really make a difference for yourself and your returns. And just to summarize the 4 key concepts and takeaways we covered, number 1 is asset allocation. So have a well-diversified portfolio across countries, US and international, sectors, and factors, such as small companies and value companies. Number 2 is rebalancing. Periodically rebalance your portfolio back to your target investment allocation by selling some of what's performed best and buying some more of what's underperformed. And consider using tolerance bands for rebalancing, along with understanding how often to review your portfolio. Number 3 is asset placement. Own the right investments in the right accounts in order to minimize the drag from taxes and capture the best after-tax return you can. And lastly, number 4 is tax loss harvesting. If you have a taxable investment account, be sure to take advantage of market pullbacks by looking for opportunities to harvest investment losses for tax purposes. Well, thanks everyone for your continued support with the podcast. We've really enjoyed hosting it, and we appreciate all of you taking the time to listen in. And as always, you can access the show notes at mdwmllc.com/podcast. And you're welcome to email us at info@mdwmllc.com if you have thoughts to share or questions that you'd like to have answered. Well, take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight for Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.